What's up, everybody? Michael Silva here. This is the Stock Market Brief Show. Looks a little different. I know it. It's titled Something is Going to Break. This is part one. So part one, I'm going to be talking about what is taking place in the markets, and I want to just make people aware what's going on. It may sound very bearish, and I'm not trying to be very bearish here, but I want to just make sure people are aware of what is taking place so they can potentially be prepared if something big does take place. In part two, I'm going to be talking about more specifically the indices and the risk that I see building in the indices. I'm not just going to say narratives. I'm going to show you with cold facts what the options market is pricing in. And it's some very interesting stuff. If you follow me on Twitter, I posted, if you thought this week was wild, just wait till next week. So we got a lot to talk about. Part one is now. Part two will be coming out later. Be sure to watch that. Let's get into today's episode. All right, everybody, welcome back. We are looking here at a cycle chart, okay? The blue is an economic cycle. The orange is a stock market cycle. If you watch this channel, we talk about the stock market frequently. And we're always trying to pick out tops, bottoms, etc., and find turning points in the market to, well, make money, I guess, is the simplest way to put it. And as it stands right now, when you look at the 11 sectors above us, energy is typically performing best near a market top. And what we're seeing now in the markets is energy, well, is performing the best, hands down. But as we turn slightly over this top, what you start to notice is defensive names start to perform significantly better. And what are the defensive names? Consumer staples, utilities, healthcare. If you watched the video yesterday, I dove into industries too as well, and why I've been focusing heavily on becoming more defensive coming into the second quarter. Okay, and during these turning points, it's an early indication that when these start performing well, it could be coming to a top of an economic cycle where we're heading into an early recession. And if you're watching the 10s and 2, the yield curve, which we'll go over later, you probably are aware that, well, an inversion looks pretty imminent. Now, I told you energy is performing very well. Look at the price of oil. It continues to just fire off to the moon. Now, I understand that there's geopolitical risks, and this could very well change if things change over there. But as it stands right now, oil continues to press higher and higher. And the thing is, if oil continues to press higher and higher, something is going to break. What do I mean? Well, let's just take a look at monthly chart of oil. It is coming right now. It's above currently where it was in, all the way in 2010. So it's above these 2014 highs. And this right here, surprisingly enough, it hasn't put too much pressure on things yet. But something can very well break if this rate at which this moves continues to press higher. And understand it can go a lot higher, right? Given our current conditions and the current economy of what's taking place, I'm not trying to time it specifically, but understand the rate at which these move can cause some significant damage to the economy. And more specifically, what I want to point out is this, the rate of change. I'm using a 12-month rate of change, so 1 year. So rising oil costs here in the last 40 plus years have led to recessions. And they've been precursors to bear markets. 1987 crash, you saw the rate of change get up to 100. 1990 crash, you saw the rate of change of oil reach up to that 100 point right there. .com, the financial crisis. And I understand that we're coming off some significant lows here, which is going to skew this rate of change as we bounce off. But understand we've already pulled under that line. We came back up, we pulled under, and we came back up again. So the rate at which oil is moving here is mimicking what we've seen in previous, recessions and tops of markets, okay? But it's not just oil. We have rising cost of wheat flying through the moon. We have corn flying right now. And we talked about this in our last weekly recap as well, saying that if it starts closing below these weekly candles, what to expect in the markets. Did they close below the weekly candle? Not even close. They fired off like a rocket ship. Now this is where it gets interesting. Gold is going up. Silver is going up. The CRB index is a basket of commodities. You know the Fed watches the CRB index. It's up 13.43% on the week, making last week's shooting star candle almost invisible. This is crazy, right? Inflation is getting out of control, right? We had a 7.5%. We have inflation numbers reporting, I believe it's next week, right? PPI, CPI, we have retail sales, the market is being thrown around by a lot of news events. So this is going to be a big thing to watch. Now, this is where it gets very interesting, folks. You might think that inflation is going to continue to rise, and you might be right from a number perspective. But the rate at which it moves up higher and higher may start to slow. So if we have growth slowing down and we have the rate at which inflation slowing down, that could put us in a deflationary environment. And what I find so crazy about this is all those commodities that we just recently talked about are going up with a rising dollar. That's weird to me, right? I mean, it's happened in the past. But understand that typically when you get a dollar rising at this rapid rate too, you typically have commodities back off. But we're not seeing that right now. So what does that mean? Well, for example, here is an article from Farm Futures. And I wanted to point this out because it was important to know, because people think, okay, no, it's an inflationary environment. It's going to continue to be inflationary. And they may be right? I'm just trying to point out different case scenarios. But understand, a strong dollar in a global market will increase the price of commodities relative to foreign currencies. The higher price of commodities in foreign currencies will work to lower demand. Go figure, right? and dollar price commodities. So in that scenario, when you have increasing commodity prices abroad, that causes domestic deflation. If we take a look at the yield curve, the 10s and 2s, this thing has been getting hammered. It's at 0.24 now. It's I would have to say this is imminent of an inversion. It's headed directly there. All right, we're seeing massive volatility in the bond market. The Fed, they're going to be acting, right? We're seeing rising costs of inflation. What are they going to do? Are they going to lift rates in this environment? And what's going to happen when they do? Something's going to break. People are saying they're going to make a policy error. I mean, in my opinion, the policy error was already made. So they're going to move from very accommodative to less accommodative. Something is weird here taking place in the markets. And as we already stated, right? Typically at the market tops, energy performs, and then all of a sudden it comes into more defensive names. And, I'm not just trying to make narratives here. I'm going to try to show you what is taking place right now in the market. Look at consumer staples. Now, you might look at this chart and be like, it's actually kind of down on the year. It's whatever. But I want you to pay attention to its relative performance. That is what's important. Its relative performance in 2022, boom, relative to the S&P 500. So consumer staples right here is something that is outperforming the S&P 500. So it is a safe defensive name that is outperforming and could continue to outperform. And if you're looking at it from an absolute perspective, it does look like it's going to break out. It does. It doesn't mean it's going to. Even if it goes down, this line can still go up. It just means that this will go down at a slower pace than the S&P 500 in the broad markets. And we'll talk about that in part 2. Utilities firing off. Now, there's going to be periods where this is going to digest, but this is completely and utterly firing off right now. Okay, the relative strength line, boom, completely vertical. Defensive. So where are people putting their money right now? Where is rotation taking place? Rotation is rotating, or money is rotating into safety. The TLT, right? This has been extremely choppy, as you can see. So when yields back off, this goes up. When yields fall, well, this will go. When yields back off, this will go up. When yields rise, this will obviously fall. They have this inverse correlation. But what I want to call out here is, if you look at 2022, go up, right? Relative strength line, boom. It's been a flight to safety. So in absolute perspective, it doesn't look all too good, but relative to the S&P 500, it is a safer bet. And that goes with the long term, but also the shorter term. So the SHY. SHY from 2022, boom. Nice steady move to the upside relative to the S&P 500. It is outperforming the S&P 500, and the S&P 500 is cap weighted. All right? What does cap weighted mean? Whoa, why did I just change the pen? Cap weighted means that they have, the top 10 stocks make up for the majority of the index. And the top 10 stocks are growth stocks. And as we're entering into a period where growth is slowing, well, guess what? Those stocks that are the big dogs of the S&P 500, and by the big dogs, I mean, Apple, right? Microsoft, Google, Facebook, Tesla, Netflix, etc. If those start heading downward, well, that's going to be very hard for the S&P 500 to hold itself up. And as the yield curve continues to flatten, you know what else doesn't do good in that environment? Financials. Financials do not do good with a curve that is flattening, and we're starting to see that. So if financials break down, which makes up a big part of the S&P 500, and then you get growth slowing, so you have big tech stocks falling as well, the S&P 500 is going to get hurt. And we'll talk about the S&P 500 in more detail on the next video, because the S&P 500 is performing rather well overall relative to the other indices. But that's because energy has been holding it up. Let's continue on. Gold, right? Relative to the S&P 500, firing off like crazy. Bullish, okay? I mean, there's going to be periods of pullbacks, but at least as it stands right now, gold looks like a safe bet on pullbacks in this environment as it stands right now. Can it change? Obviously, but this is what's taking place right now. XME, this is the spider for S&P Metals and Mining. It's an ETF. This thing, I've been watching this and I've been waiting for a pullback this entire week, and I did not get a single day where it pulled back, and it just kept on running away, and I just can't chase it. Okay, so there are going to be various miners that are still setting up. So miners can be a very good thing. Gold can be a good thing, as we're seeing already relative to the S&P 500, right? It's all about finding alpha or protecting capital. In this environment, you don't want to go all crazy. You want to protect your money, protect your capital, all right? And we'll, like I said, in the next part, we'll show you the VIX and we'll show you volatility. It's insane. And then the last chart is this, the UUP. This is just a bullish dollar fund, outperforming the S&P 500 in the year 2022. The dollar is outperforming the S&P 500 from this relative strength line as it's firing off like crazy. Okay, so these are areas where you want to pay attention to. This rotation into safety is where you want to pay attention to as it stands right now. Something is up. Something seems like it's going to break. Does that mean it's going to happen tomorrow? No. Does that mean it's going to happen later this year? Not necessarily. Does it mean it's going to happen next quarter? I don't know, maybe. But what we need to do is just be aware of what's taking place in the market. Because a lot of people are still stuck on, okay, I'm going to go long Tesla right here. I'm going to go long Google right here, which, you know, some of these companies are obviously great companies. But just because they're great companies doesn't mean that their stock performance is going to do good in a slowing growth era, I guess could be the word. Okay? And other people are still looking at crazy companies like, I don't even know, just, Big Five, or things that just squeeze up to the moon and then get constantly hit. Be careful. This is not where you want to be a gunslinger and all crazy. That worked in 2020. It worked into 2021. Right now, that's not where the relative performance is. All right? That's all I got for you on part 1, everybody. Get prepared for part 2. See you later.